What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So we have a couple of really cool things that we need to discuss in this update. We are going to go over some of the reasons why AMC is set to have some really substantial moves to the upside. We are going to go over some of the key pieces of the Ortex data, the potential for that double buy that we have been talking about in terms of a gamma squeeze on AMC's options chain, and then we are going to be going over some of the very key reasons why hedge funds potentially will be going bankrupt in the near future. There's a couple of key reasons for this, and if you guys saw my tweet earlier, it kind of has to do with the concept of opportunity cost combined with the amount of leverage that is already out in the market right now. This is a really cool situation that I want all of you guys to understand, so make sure you guys pay attention to those key concepts. Now, we also have to talk about some broad market concepts and how they're going to affect not only AMC, but the broad market as well. We have some debt ceiling updates, we have some Evergrande updates, and again, I am still expecting to see a decent amount of volatility leading up into that Fed meeting on the 14th and the 15th, but once we pass that date, we could receive some blue skies ahead. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So today, AMC had an absolutely awesome day, closing above that $31 mark, up 7.82%, up $2.25 on the day. After the last couple of days and weeks that we've seen on AMC, it was really awesome to see this kind of green day in that type of magnitude. Now, when we come over to the Ortex update over here, we're seeing the utilization at 76.81%. I still would expect this to be a bit higher than what it is at the current time. And then we're seeing the estimated short interest at about 18.63%. It is slowly climbing back up. So to those of you guys who are getting a little bit worried about what we were seeing on Ortex, the numbers were in the 15% range. Well, if this doesn't really tell you much, the shorts have not covered their position. We are still waiting on that new exchange reported short interest data, and once we receive that, it is going to be 2 weeks delayed, but that is going to give us a little bit more insight into exactly what we're looking at for that short interest. And again, that is only the reported short data. We have gone through many times on how they are able to hide this short interest through the option chain and some examples of how they're doing that on AMC. But then one of my favorite metrics right now, the days to cover, is steadily climbing on that 3-month time frame. 2.1472 and a couple of other numbers on there too, but basically 2.14 on the days to cover metric. Essentially what we're seeing here is that even if the shorts felt the need to start to get out of their position, unwind some of those shorts, the buying volume that they would be able to push into the market would drastically increase AMC. And we are seeing this number get even more dangerous for the shorts every single day. Again, we saw AMC go up 7.82% today with a volume of only 47.83 million. That is a very strong thing to see. Now, again, when we come over to this piece right here on Stonko Tracker, well, we've already really seen the effect of the puts coming in the money. We've seen the puts run in the money over here for this next week expiration, and we've seen a lot of calls run out of the money. But with what we've seen today on AMC, let me just give this a quick refresh to make sure we have the most accurate data here. So we have 71,000 puts in the money, 27,000 calls out of the money. Now, I'm focusing on the next week expiration because that is the monthly, and we're not seeing a whole lot of action on this week's expiration. So when we start to see that move to the upside, we could be getting that double buy, and that could lead us into that positive feedback loop of buying from the market makers in terms of delta hedging these options that they've sold, FOMO, and some shorts covering their positions. Now, when you combine that with all the data that we've seen, the short interest is higher, the days to cover is higher, which means that any new buying volume that gets pushed into the stock is going to affect it more. AMC is looking pretty freaking dangerous for these shorts right now. Now, let's get into this situation surrounding hedge funds and the potential risks that they have on their balance sheet right now and how a lot of them, specifically most likely the smaller ones, are having significant issues. So when we bring ourselves back to this situation from Goldman Sachs, remember, Goldman Sachs is the top prime broker in terms of prime brokerage operations. So the highest volume of securities lending, the highest volume of essentially margin loans going out to any of their clients. And all of those clients are most likely going to be large hedge funds. So what we see here is that previously, about a week ago, we saw the largest 10-day net selling in U.S. equities since April of 2020. Remember, that was when we were seeing some aggressive downturn in the overall market as hedge funds continue to reduce net short exposure through shorts. Trading activity December 3rd, the largest 10-day net selling, yada, yada, yada. The Goldman Sachs Prime book was net sold short for the third straight day. And they go over some standard deviations here, driven again by short sales outpacing long buys, 4.5 to 1. That is a very, very high ratio. Now, what happens when the overall market, like today and yesterday, start to come up in the other direction? Well, these shorts are going to get mini squeezed out of their positions in SPY and a couple of these other big indexes. But if they're putting on these short-term shorts in any individual equities, well, they're going to get squeezed out of those too. The other thing that we need to look at is this situation on a broader time frame. And when we come over to this screenshot right here, this is tracking alpha. What alpha is in the finance and hedge fund world is essentially how well do you perform versus the overall market. Now, when we look at this chart right here, we are seeing that the cumulative alpha for long-short hedge funds right here, which is the majority of hedge funds, is negative 11%. Now, when we think about all of these things as a whole, remember, November 15th was the last day of the year that fund investors were able to tell those funds that they were going to be taking their money out by the end of the year. So what we're looking at here is, well, all of these big funds who think they're smarter than everybody else, claiming that they can generate really substantial returns for their clients, they aren't. They are underperforming the market, and their clients are seeing this and are really looking at this in a way that, well, I could have just put my money in the S&P 500, received the dividends, paid the expense ratio fees on that investment, and done much better than if I gave my money to these people who thought they were smarter than everybody else. The other thing that we need to look at here is that if these institutions, these funds, are going to be receiving a lot of redemption calls going into the end of this year, in the beginning of next year, which most likely they are because these funds continuously underperform the overall market, well, they're going to have a very significant problem maintaining those maintenance margin requirements maybe set out to them by institutions like Goldman Sachs, who by themselves have about a 133 to 1 leverage ratio right now on a lot of those derivative positions, just like we showed you guys in a couple of videos ago. I believe that was on Sunday. Now, just to put that into perspective, that leverage ratio, 133 to 1, well, that essentially means is that if I personally were to have a 133 to 1 leverage ratio, if I were to have $1,000 in my account, I would be able to trade $133,000 of equity securities, whatever you would like to call it. The second thing is that in 2008, when Lehman Brothers essentially collapsed and they were kind of the first domino to topple, their leverage ratio was about 40 to 45 to 1. That really puts things into perspective here. And if these institutions are going to have money taken from them and they are levered up, well, they're going to have significant problems, and we are going to see a lot of these institutions starting to do what Citadel and Millennium are doing. Now, with Citadel's leverage ratios right now at about 7.4x, remember, we can't necessarily get a really good understanding of what Citadel's actual leverage ratio is right now, but 7.4 is pretty high. That means for every dollar that they have in assets, that they would be able to get about 7.4 more in margin. Now, if their clients say, hey, you have underperformed, you have not generated the returns that I thought you were going to, they are going to pull their money. Now, we've seen the Citadel notice that essentially says that if they are going to see 3% of their funds withdrawn, then it is going to step down to that 6.75% about withdrawal window, which is going to take forever for these clients to get their money back. So they're essentially stuck. All of these large clients that essentially have their money at these institutions are paying the gambling debt for these institutions, levering up way more than they should be. Now, some of these smaller institutions are not going to be able to do the things that Citadel is doing right now. Citadel knows that they are kind of one of the top dogs on Wall Street, and if their clients leave, they aren't going to let them back in because they already have so much money under management. But the smaller institutions, if they are underperforming, they're not going to be able to essentially say, hey, we're going to lock up all of your money for this period of time, because all of these larger fund managers and these larger investors are just going to say, no, I'm taking my money, give it right back, I'll pay the fee and go somewhere else. This is a really interesting situation that we need to watch because all of these institutions are underperforming the market. Their leverage ratios are incredibly high, and their clients are most likely right now very unhappy with a lot of their performance. So make sure you guys are watching out in the news for any of these large institutions kind of going under, closing their doors. We've seen this happen in the beginning of the year and kind of in Q2 as well over in Europe. So these situations could really start to happen again. Now, going into some of these broad market situations, McConnell says a deal was reached with Schumer on the debt limit. This is essentially going to allow the Democrats to temporarily fast track the process, which would allow them to increase the debt limit with 51 votes, bypassing the filibuster. Now, when you think about the debt ceiling, is this really going to be healthy for our overall economy going over the next 10, 20 years? Not really, but it is going to be something that is going to allow some short-term bullishness in the market. Is the actual national debt in all of these potential debt ceiling increases really going to help us in the long run? I don't think so, but at the same time, if we want to make some money in the short term, it is going to help really make sure that the United States does not default on all of their debt obligations. Then we also have this Evergrande situation. So Evergrande restructuring puts onus on Xi to limit contagion. We've talked about this in the past, that what was most likely going to happen with Evergrande is that the Chinese government was going to step in and it was going to essentially put Evergrande into bankruptcy, restructure the whole organization, break it up into 3 different organizations, and then go from there to try to limit the eventual downfall and having the spread to the global markets. And this is something that we kind of needed to see out of Evergrande. Could this still have global fallout? It could, but most likely what the Chinese government is doing right now is trying to make that fallout less aggressive and less bad than it was going to be if they didn't step in and try to do something about this. So the last thing that we really need to focus on is the Fed's tapering of asset purchases and how fast they are going to speed that up. When we think about inflation right now, the Fed knows that inflation is running much higher than expected. Now, they're going to come out and use the excuse that the economy is recovering. That is why we're going to be speeding up the tapering of asset purchases. Don't let them fool you. The only reason why they are doing that is so they can get to the rate hike faster in order to kind of stifle the inflationary pressures that we are seeing in our economy that are kind of causing a lot of problems in a lot of different industries. So make sure you pay attention to that. After December 15th, we could see a lot of bullishness come back into the market, and then we go on that Santa rally. So that is going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great day, and I'll see you guys in the next one.